Good afternoon. This is Josh here at Chaikin Analytics, and I'd like to welcome you to our presentation of how to make consistent cash with covered calls. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, along with Tony Zhang, chief strategist at OptionsPlay. Chaikin Analytics is not registered as a broker-dealer or investment advisor, either with the U.S. Securities and Exchange Commission or any state securities regulatory authority. Chaikin Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. As a reminder, this webinar is being recorded and a copy will be sent to all registrants tomorrow. Please submit any questions that you have via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. To get us started, here is Marc Chaikin.
Josh, thank you very much. And we've got a special offer for everybody for a new options service that Josh is launching next week. So very exciting day for all of us. We're going to talk about generating income. The market's been extremely volatile. There's been great trading opportunities, but we know from feedback from our clients and from surveys that we've done that people are still looking for more income. So I'm happy to be joined today by Tony Zhang from OptionsPlay, which we integrated into Chaikin Analytics 3 years ago, and Tony will be with us in a minute. A little bit of my background: 50 years on Wall Street. For 45 years, I've been using technical analysis in conjunction with fundamentals because I realized early on, the first bear market I encountered, that you needed something that went beyond fundamental analysis to survive, protect capital in a bear market. And that, for me, has always been technical analysis. And what we do at Chaikin Analytics is to combine fundamentals with technicals. For 5 years, I headed up the options department at a regional brokerage firm called Tucker Anthony, 20 offices scattered out through New England, and tens of thousands of options traders. And a lot of what I learned and what I tried to teach back then is going to be reflected in this webinar. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were clients, some of them were colleagues at firms like Tucker Anthony. The common thread was they all followed a discipline, and that's the reason they were successful. People like Peter Lynch at Fidelity, Bill Miller at Legg Mason, Roger McNamee, who ran the T. Rowe Price New Horizons Fund. Everything I learned from them, I poured into a year's worth of research when I came out of retirement in 2009 after the financial collapse of '08 to create what is the culmination of my life's work, the Chaikin Power Gauge rating. 20 factors, fundamentally oriented, that successful institutional investors look at every day. And now we've got Power Gauge rating for the 500 most actively traded equity ETFs, combining fundamentals and technicals. The Power Gauge rating is your edge in options trading. What I learned at Tucker Anthony was 95% of options traders lost money. Today, we're going to be talking about primarily income strategies, but right at the end, we're going to throw in some directional trades based on a market bias that we have right now. But even when you're looking at income strategies, you need to know where the stock is headed, because if you get into an income option writing strategy on a stock that's going to drop 30%, there's no way to protect yourself. So with that, I'd like to introduce Tony Zhang. He's become a partner and a friend, and he brings a wealth of knowledge, and he's going to tell us about his background and particularly how it played into the starting of OptionsPlay.
Thank you, Mark. Thank you, everyone, for joining me this afternoon. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I myself spent the first 7 years of my career as a technical analyst, as a market strategist, helping clients on the retail and institutional side better understand currency markets. And that's really how I learned to understand the psychology of trading, how other people applied technical analysis and other forms of analysis to their trading. And technical analysis really allowed me to help analyze not just currency markets, but also interest rate markets, commodity markets, equity markets, all of these markets that are interconnected. And that's really how I got my passion for trading. And I've spent the last 6 years building option trading tools, because when I started trading, I used to have 4 screens on my desktop. I had lots of different tools to give me the different things that I needed. And none of that stuff was automated. We had to do a lot of manual work. So we wanted to take the steps that we took as traders ourselves and create a platform that automated a lot of that work that we would have to do, the repetitive manual work that we had to do with options trading. And that's how we went about creating OptionsPlay. And that's what we're here to show you today. Really designed to help those of you that are learning about options to better understand where to start, providing you with analytics so that you know exactly what your potential risks and rewards are. And also at the same time, taking a lot of the complexity out of the picture, very much like what we're going to show you here today, the combination of what Mark will show you with his power gauge rating and how you can leverage that with OptionsPlay to quickly find income strategies and even bullish and bearish strategies on any underlying stock or ETF.
Well, thank you, Tony. And I thought I'd start today's webinar because we had another very volatile day in the market, intraday swings of 200 and 300 points in the Dow, and people are concerned, and I wanted to address those concerns. We've gone from an uptrend on autopilot in 2017 to now our second roller coaster ride of 2018. It's been a challenge for people because the headlines can throw you off your course. So I thought I'd start by looking at the market and analyzing it from the point of view of the Chaikin tools. Now, we're looking at a one-year chart of the SPY. This is the most actively traded instrument. It's the ETF that mirrors the S&P 500. And you can see that in January through March, we had a pretty steep decline in the market, actually more than 10% on a closing basis, and we'll see how important that is in a minute. You rallied up after the initial wave down, and then we tested those lows in the 2533 area. Typically, when the market closes down more than 10%, it takes time to form a bottom. That hasn't happened yet in this current decline. We had a big intraday down day toward the end of October that got us down to 2,600. We closed right at 2,700 on the S&P today, but we haven't breached that 10% down on a closing basis. That would require a close under 2,650 on the S&P 500 index, roughly 265 on the spider. That's our line in the sand. If that gets breached, in spite of the fact that we're bullish based on an earnings environment that's so positive, we will have to reevaluate how much time it's going to take to form a bottom. Now, at the bottom of this one-year chart, I'm proud to say that we have something unique that we haven't talked about on a webinar before, because we've just launched our power gauge ratings for the 480 most actively traded US equity ETFs, including the SPY. And the power gauge rating is bullish as of a week ago on the SPY, but we did get overbought. And so a pullback was in order from that 2,800 level. Remains to be seen if it's going to stop. We seem to be going through these big selling waves. This day was characterized by Apple. Everybody's downgrading it, leading the charge on the downside. We did get a rally to break even. It's wild out there, and therefore you've got to have a plan. Now, if this is a bear market, which is what people are saying on CNBC, it will be the most advertised, widely anticipated bear market in the 50 years I've been on Wall Street. It just doesn't work that way. Things don't happen when they're telegraphed on CNBC. They happen out of the blue. So we have a view that once the dust settles, earnings will still drive the market. And historically, after the midterm election, those 9 months are the best 9-month period of the 4-year election cycle. So once we get all these concerns about tariffs and the tariff war with China and Fed raising interest rates cleansed out of the system, and the sellers of Apple and Amazon are all done, I believe we're going to rally up to new highs, perhaps even by year end. But I'd like to put pullbacks into perspective. This chart shows you what's happened since 1945. That's 73 years. And it's about 9 months old. So there's been another series of 10% declines, or 5 to 10. There have been about 78 declines of between 5 and 10%. They typically average 6% on a closing basis. They last a month. This one's heading into 2 months. And the average recovery time to new highs is a month. That's what's known as a pullback. And pullbacks are actually your friend. Hard to anticipate them. If you sell out, hard to get back into on a moving train. What's problem is declines of between 10 and 20%. Beyond 20%, you're in a bear market in the S&P. 10 to 20% is called a correction. And we just saw the correction that happened in February or March of 2018. Those declines take time. There have been 28 of them now since 1945. They average 13% on a closing basis. That's what happened in February. Average length 4 months, and then the good news is you get back up to a new high 4 months later. It's yet to be proven that we're even in that kind of an environment, no less a bear market. We haven't closed down 10%. That would require a close below 2650. It could happen, in which case we'd recommend sort of standing aside, sitting on cash reserves. But until that happens, we're looking for buying opportunities. In today's webinar, we're going to explore income-oriented buy and write strategies. Now, we've been operating under a very simple scenario that when earnings are rising, GDP is going up, and interest rates are rising, that's very bullish. That's what's happening now. Third quarter earnings exceeded expectations. 2019 earnings are expected to be up about 9%. We're in an earnings-driven bull market, but fear is everywhere. And you've got to make sure you don't get derailed by the headlines. So when interest rates are going up because the economy is strong but not yet overheating, and that's where we are right now, the very reasonable level of inflation, that's a bullish environment. We should be looking for buying opportunities, or in context of today's webinar, buy and write opportunities. But in case you have a different view, you can use options on the SPY to either hedge your long portfolio if you have a 401k plan, or make a bet on the downside. So Tony Zhang is going to explain a very simple concept called vertical put spreads, which are bearish, or vertical call spreads, which are bullish, a little later in the webinar. But what I'm showing you here is that for $456, you can hedge a 6% decline in the market in the SP 500 through mid-January. You're buying a lot of time. If you have a $270,000 401k plan and you don't want to sell out your ETFs or your mutual funds, you do 10 of these spreads. It costs you $4,560, and you've hedged that portfolio for a 6% decline. Or as I say, if we do get that decline and you're a speculator, you make 300% on your money. And it's cheaper than just buying the 271 put outright. Tony, you want to just come in and briefly explain why this strategy makes so much sense vis-a-vis just buying the put?
Yeah, absolutely. So as you can see here, buying a put is $805, which is 4% of your portfolio value, or 4% of the underlying portfolio, which is quite expensive. If conceptual perspective is very similar to buying insurance. However, if you're constantly buying insurance that's extremely expensive, it may offset any gains that you might get from hedging. So it's really important to time your hedging correctly and also do it as efficiently as possible. And as you can see with the debit spread on the right-hand side, it costs you less than 2% of the underlying to buy a hedge. So only about 1.7% of the underlying portfolio to buy a hedge to protect yourself against a 6% decline. That is a very cheap hedge. Allowing you to basically buy some insurance and protect yourself to the downside if you do get an initial pullback. But even if it doesn't, you're not risking 4 or 5% of your portfolio in order to put on that hedge.
And you sleep better at night. And notice that OptionsPlay automatically, and we bundled OptionsPlay into Chaikin Analytics, it gives it a green positive circle rating, and then it's almost like a bullet on the Billboard record charts. They like this strategy from a probability basis. They is not Tony Zhang. it's the computer programs that they wrote. Very consistent with Chaikin Analytics, which is probability based. So I'd like to ask a poll question here. What's your biggest stumbling block on the road to options profits? Josh Minland's going to put up a poll question here, and you can just select one of these answers and click the submit button. So is it stock selection, is it timing, or is it finding the best option strategy? I always try to answer, and it doesn't always let me do it.
I think I gave you a shot at it today.
Yeah, I got it this time, Josh.
Okay. I will give it just another few seconds, and then I'll share the results with everybody. All right.
I'm guessing it's timing.
You would be correct.
It was a close fit. OptionsPlay is incredible for finding the best option strategy. Chaikin Analytics is great to help you with the timing and the stock selection. That's why we've partnered with them. Really feel strongly about this. It's been 3 years, and our members have really responded positively. So let's look at a problem that a lot of people have, especially options traders, which is information overload. Especially if you're not using a program like OptionsPlay, you're looking at option chain tables on your online brokerage app, Thinkorswim or Schwab or Fidelity. You're bombarded with the Greeks, delta, theta, gamma, beta, you name it. Information overload is a huge problem. Social media is now contributing to it, and tweets don't help either, no matter what your political bias is. They've been pushing the market around, tweets about tariffs. There's so much information to process. That's why we started Chaikin Analytics. We think it's the solution to information overload. It's for iPad and desktop. And we've bundled OptionsPlay in. So Tony, why don't you walk people briefly through these 3 panels that reflect what OptionsPlay does so well?
Yeah, so the first concern that a lot of people have when they're starting out with options is not knowing where to start. Number one, you're not sure exactly which strategy to take. So if you're bullish on a stock, do you buy a call option? Do you trade a more complex option? And then more importantly, once you've chosen a strategy, how do you figure out what expiration date and strike price do you choose? That's really where we see a lot of beginners tend to stumble. And that's one of the first problems that we try to solve with OptionsPlay is all you have to do is say, I'm bullish or I'm bearish or I'm looking for income strategies, and we will auto-generate strategies that make sense for you as a starting point. And this really helps facilitate beginners to explore and learn about options without feeling overwhelmed and not sure where to start. And for those of you that have experience trading, this is really designed to just save you time from having to pull up that full option chain every single time and having to go searching through pages and pages of those charts to determine where is just a starting point. And then what we do is we provide a bunch of different tools to help you fine tune each one of these strategies, everything from interactive panels to help you understand those strategies for those of you that are beginners, and then tools such as our P&L simulator that really allows you to create different what-if scenarios so that you can actually compare 3 strategies side by side. Those are some of the things that I didn't have access to when I first started trading options, and we did a lot of manual back and forth between the option chain and another tool that would do the analytics on a specific option strategy. So we wanted to combine the best of both worlds into a single tool that you guys have access to, giving you all the starting points that you need to get up and running, and then more importantly, giving you the tools to fine tune each strategy so that you can select the correct expiration date, strike price, and even modify them for more advanced strategies if you'd like.
And by the way, that's what I did on some of the buy and write strategies that we're going to look at today. OptionsPlay can do a lot for you. And Tony has really helped us refine the message in terms of what OptionsPlay can accomplish. So Tony, why don't you take this slide, because it really reflects your thinking on creating OptionsPlay and making it available to people.
Yeah, absolutely. So this really follows our philosophy here at OptionsPlay, is to try to make options trading as accessible as possible to as many people as possible. And what we really learned from is our own trading experience as traders. Learn from the steps that we took, learn from the mistakes that we made as traders, and really tried to create a platform that helped everyone facilitate and not make the same mistakes as we did. So as I said in the previous slide here, for experienced traders, this is really designed to save you time, because as a trader ourselves, we used to spend a lot of time scanning through those option chains, looking for the same strategies and over again. And we basically asked ourselves the question, why do we keep doing this manually when it can be automated? And that's what we're bringing to you guys, for those of you that are experienced, is instant strategies regardless of what your views are. You simply type in a view and we'll provide you with strategies as a starting point. And then we looked at beginners. We said, what is the challenge for beginners? And it really tends to be, number one, where do I start? What strategies do I choose? Which expiration date? Which strike price? And then more importantly for beginners was really understanding, how do I even evaluate these strategies once I figured out a starting point? And these were all the problems that we tried to solve here with OptionsPlay. And our philosophy is to bring everything to you in plain English, because a lot of things with options have terminologies that people don't understand. There are important things to look at that are called the Greeks, which I think they do just for fun to confuse beginners. We really want to take that complexity out of that and show it to you in terms that you can understand. Everything is color coded. Red is bad, green is good. Very similar things that you would see in other aspects of your life that have made user experiences with many other things easier. We're trying to apply that to options trading.
And it's so compatible with what we believe at Chaikin Analytics. We believe that fundamentals drive the market, but emotions drive the market to extremes. We've seen that over and over again here in the last 3 or 4 weeks. So for me and for Chaikin Analytics and our members, the path to profits is a combination of fundamentals and technicals. It's a probability-based approach, and so is OptionsPlay. So very consistent. Because we've taken this unique stand about combining fundamentals with technicals, we've gotten some validation from some really successful traders and market commentators, people like Dr. J, John Najarian, who you see on Fast Money, John Carter at Simpler Trading, and of course my good friend Jim Cramer. We just did a 1-hour webinar last Wednesday with Jim live from the Street.com's headquarters. Jim has become a big fan of the power gauge rating. He has been using Chaikin money flow since the early 90s, but he's come to realize that this combination of fundamentals and technicals is unique, and that's what we're going to be concentrating here on this webinar. So the Chaikin Power Gauge rating, as I said earlier, it distills everything I learned from very successful institutional investors down to a simple gauge, but please don't confuse simple with simplistic. There's a lot of powerful number crunching going on under the surface. And what I like to say is that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. It gives options traders a directional edge. And now we have our new power gauge ratings for all equity ETFs that combine fundamentals with technicals. The directional edge is the key. That's why 95% of options traders lose money. They don't understand that a stock has to go in a certain direction in a predefined period of time. So they buy out of the money options with short duration, expiring soon, and they've skewed the odds against them. Whereas if you use something like the power gauge rating and the OptionsPlay strategies, you can put the directional edge on your side. So what does the power gauge do? Well, it evaluates the important fundamentals underlying a stock, cuts through all that clutter that you see on the right, which is fundamental data that analysts look at on Wall Street, and distills it down to a gauge like you see on the left for Progressive, 4 primary factors, 5 sub-factors in each of them. And these are the factors that successful institutional investors look at every day. 20 years of working with them, 30 years really. They all looked at different things, but they all followed a discipline. So what is the power gauge rating? Well, it looks at value, growth, technical, and sentiment factors. And with each of those 4 primary categories, 5 sub-factors. Value is 35% of the model. It cares about whether a company is generating positive cash flow and not selling at too high a price relative to sales. 85% fundamental, only 15% technical, and some really interesting factors in there that aren't in most models. Industry group strength, analyst estimate revisions, short interest, insider buying, and in the context of earnings season, earnings surprises, very big influence that drives short-term stock price movements. We've had great success, particularly on the short side, with stocks that have reported positive earnings surprises, negative earnings surprises, really tanking and taking advantage of that ahead of earnings. Also, as you'll see in a minute on the long side with advanced auto parts. So what's the performance been of the power gauge? Well, over an 18-year period through the end of 17, some of which is simulated, but everything since 2011 is real time. The average very bullish stock in the Russell 3000 up 20% a year, while the average very bearish stock is up only 1%, and that's after a 9-year bull market. So think of that. If you're looking for income-oriented option strategies, if you're focusing on bullish or very bullish stocks, you're more likely to have a successful outcome with the dividend and the options premium factored in than if you're dealing in very bearish stocks, because they're going to hurt you, as they did in 2015. In 2015, energy stocks and small caps were in their own bear market, down at 1.28% on the year. It was important to know which stocks had a very bearish rating, because these were the ones that could destroy your results. And a lot of the brokerage firms stayed bullish on these stocks, like Kinder Morgan, which had a very big dividend, Under Armour, energy stocks in general, from the offshore drillers like Diamond Offshore, Transocean, to the suppliers like Schlumberger, Halliburton, and Helmerich and Payne. It was important to know that these stocks had negative fundamentals based on an objective third-party measurement that we call the Chaikin Power Gauge. Now, on the webinar that Jim and I did last Wednesday, Jim said, I want to explain why I love Marc Chaikin's stuff. It's simple, it's understandable, it's rational, it's not emotional, and you know I use it constantly and I almost never want to go against it. High praise indeed from someone I have a great deal of respect for. One-on-one, Jim is totally different than you see him on Mad Money. Thoughtful, compassionate, but more than anything, as an old client of mine, I know that he knows markets. So let's look at that thoughtful, methodical pattern that Jim was talking about, classic Chaikin bulls. These are the stocks that give you your upside performance. They also make good buy-right candidates. Bullish Chaikin Power Gauge, meaning the fundamentals are strong, outperforming the market. I'm going to tell you why that's important in a minute. Chaikin money flow is strong. Chaikin money flow has been around since 1982, being used by institutions and individuals. It's on every one of your online brokerage platforms. It measures institutional accumulation and distribution. So let's look at an example of a classic Chaikin bull. Centene Corp, Medicaid provider, they've figured out how to make money in the Medicaid business even when the government's cutting back on subsidies. Now, when we look at a chart at Chaikin, walk our members through this process, we look at it from the bottom up. The reason is that the power gauge rating is at the bottom of the chart, and that's our go-to directional edge. Been mostly green for Centene all through 17 and 18. Then we look at whether the stock is outperforming or underperforming the market. Why? Because no matter how good your fundamental model is, whether it's quantitative or seat-of-the-pants research, brokerage firm, or hedge fund, if the market doesn't agree with you, guess who wins? It's always the market. And then we look at Chaikin money flow, and if it's green like that, as it was between April and September on Centene, it means institutions are buying the stock whenever they can, even when the stock dips. So what we're looking at here is everything you need to know about what direction the stock is likely going. And even after a big volatile market sell-off, Centene is closer to its high than its 52-week low. And then, of course, we have our buy and sell signals that we're going to talk about later Our relative strength buy signal works about 70% of the time. Time horizon is 4 to 8 weeks. It's great. We talked about timing being critical. It's great for timing. Entries, we're not talking about it on this webinar, but you can leg into a buy right strategy by buying the stock when it's oversold and waiting for it to rally. That's not what we're going to be recommending today. We're going to be recommending initiating positions, but you could do that if you're sophisticated and understand the process. The key here is that there is a methodology that works, and we call it Classic Chaikin Bull. And we've created a screening program that helps you find them, because one thing to know that there's a pattern out there is another to find them on a daily basis. So this is a screen that I used on a webinar in July. I think it actually was with Tony Zhang from OptionsPlay. And I took a large cap growth universe, required that, which we provide, required that the rating be bullish, and then use those two factors from the Classic Bull, Chaikin money flow and relative strength, and then one other fundamental factor from the model, free cash flow. Warren Buffett, Seth Klarman, value investors understand the importance of free cash flow. You can doctor up earnings, but cash is cash. So I wanted quality stocks, and I got 12 names. I reduced 529 names down to 12. Now, that's eliminating information overload. And these 12 stocks were big performers in the ensuing 4 months. It's 4 months later. Centene was there. Advanced Auto Parts, we're going to look at in a minute. It was 141. Humana did really well. Disney's doing well. Express Scripts got taken over by Cigna. These are the stocks that led the market. But let's look at Advanced Auto Parts. It was 141 on July 17th. 2 weeks later, it gave an oversold buy signal, one of our 6 pairs of buy and sell signals. Now, an oversold buy is really simple. I learned it from Larry Williams, who was actually on Mad Money on Jim Cramer's show. He's very, very fine technician, been around a long, long time. This is a pattern that's really simple. The power gauge is bullish, so that the fundamentals are good, and the stock makes a new 8-day low as it gets oversold on a short-term basis. In this case, Chaikin money flow was strong. So 2 weeks after the screener identified it, we got a buy signal in Chaikin Analytics, and I'm going to show you in a little bit how we push these buy signals to you on any stock in the list you're following or a large index. And Advanced Auto Parts, after reporting a positive earnings surprise, rallied from 141 all the way to 170. Went sideways for 2 months, and guess what happened yesterday? Positive earnings surprise, and the stock went from 165 to 182. It was up 10% yesterday. These patterns repeat. 4 positive earnings surprises in a row. Look at the chart. Power gauge bullish, outperforming the market. Good things happen if you're prepared, and if you bought Advanced Auto Parts and stayed with it, you were rewarded. Now, do we want to buy it when it spikes up like that? No, we want to sell it, or maybe sell a covered call, because there's usually some profit taking and consolidating. Just another example of discipline leading to outsized returns. Now, we're not in a bear market in my view, but there's still money to be made on the downside. And when we do get into a bear market, you need to know the stocks that have poor fundamentals, that are underperforming the market, where the institutions are selling, and we know they're selling because Chaikin money flow is red, not green. Now, we've been using Centene as our poster child for a classic bull for over 6 months. And we've been using Tesoro, a biotech and drug stock, as our poster child for a classic Chaikin bear for 9 months. Again, read the chart from the bottom up. Power gauge, bearish. Underperforming the market, relative strength is weak. Institutions selling, and our money flow sell signals all along the way, negative earnings surprises. Guess what happened to Tesoro today? It was down 10%. 10% after dropping from 100 to 30 in the middle of a bull market. It dropped an additional 10% today. It's never too late to sell a stock, in my view, where everything is lined up against it and you don't want to bottom fish. Bottom fishing is the most expensive sport in America. Please don't do it. Now, all of this is building up to our option strategies. We're laying the building blocks because the stocks we're going to look at for the buy rights in the main have bullish Chaikin power gauge ratings. So summing it all up is this pyramid. Successful trading demands a disciplined methodology, and this pyramid reflects the Chaikin discipline. Power gauge rating is bullish for buys, bearish for sells. Industry group strength is important. At the bottom of the pyramid, just those two technical indicators, Chaikin money flow and relative strength. And then right in the middle, done for you options ideas. If you're an options trader, OptionsPlay cuts through the clutter and gives you the options ideas right up front. And then, as Tony said, you can modify them. So here's something we didn't promise you, it's sort of a bonus, but it's a really powerful tool and technique. It's a secret sell signal that 95% of traders never see. We call it the Chaikin bearish money flow sell alert. And it happens when a stock like Mohawk, which is in the carpet business, and we all know housing stocks have really taken it on the chin, and so have the companies that supply the housing chain like Whirlpool and Mohawk. There's a pattern that develops when a stock makes a new high and Chaikin money flow stays red, not green. We call it a bearish money flow sell alert. So it happened here in April. The stock rallied up, got overbought, and you can see Chaikin money flow stayed below the zero line. Now, how many of you have used Chaikin money flow in the past? If you have, please type a big C in the question box. And Josh, give me a quick read on what you're seeing, please.
A bunch of C's rolling in, so people definitely are using it out there.
So this is a pattern you'll never see documented. We save it for our webinars. We taught it to institutional clients since 1985. So there are two examples of a bearish money flow sell alert. The first one actually happened right at the all-time high for Mohawk at 280. The power gauge was neutral. It was still outperforming the market, but up here under that EPS logo, the stock made a new high, and look at money flow. It stayed negative. This is a powerful pattern, and Mohawk continues to make new lows and report negative earnings surprises. It's the exact opposite of what we saw in advanced auto parts, where you had positive earnings surprises leading to upside gaps and new highs. In stocks like Mohawk, and these bearish money flow sell alerts are great options entry points for speculators. Negative earnings surprises lead to new lows. And again, don't bottom fish because nobody knows where the bottom is in a stock like this. Now, everything we've been looking at, we call the ideal setup. Warren Buffett calls it the fat pitch. He has famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. And that really means timing is the missing piece. 6 pairs of buy and sell signals in Chaikin. You can go to our website, ChaikinAnalytics.com. We explain the concepts behind these signals so they're not a mystery. And they work. And the proof is in the chart we're going to see on the next slide. But yet again, just like with the classic bulls, there has to be a way to find these. So we have a dashboard in our iPad app and on our desktop. So for any list in the system or ETF or market average or the list that you create, any stock that gives a signal on a given day shows up in that list. Going back to April, Adobe gave a relative strength buy at 225. There it is. And the stock was on its way to 280. And on this chart, there are 7 relative strength buys. I said earlier, the relative strength buys work 70% of the time. They're great for swing trading because they tend to last for 4 to 8 weeks. So bullish power gauge outperforming the market, relative strength buy, it's a great swing trading entry point. Now the last one hasn't worked as well, but in spite of this terrible market, Adobe's not going down very much. This is a great stock, cloud computing, software stock, totally changed their business model. Trading on a discipline is better than trading on your emotions. Now, what is a relative strength buy signal? Because if you're using stock charts, you can find this as well. It's a stock that's outperforming the market. So Scooter is an indicator on stock charts that measures relative strength, which goes under its 21-day average and then reverses back above it. So this is a really classic pattern. Works better when the stock has a bullish power gauge rating, but the key is you start out by filtering out anything that's underperforming the market. You wait for that pullback, and then you wait for confirmation that it's moving back up again. These are great entry points for swing trading. Now, I said earlier, if you're more sophisticated, you could buy a stock like Adobe on that relative strength buy, wait for it to rally, and then sell the call option. We'll show you a couple examples of that. It's called legging into a covered right. More sophisticated, and Tony will explain it as we move forward. Now, we got a lot of feedback from clients saying, well, that's great, but I don't always have time to go into the app every morning. So we created our daily email alerts, 8 o'clock every morning for all of our members. They get an email that tells them which stocks triggered buy or sell signals or other alerts like the power gauge changing from neutral to bullish in the stocks they're following, and also in a larger list like the S&P 500. So here's the daily email alert that I got on Friday. 2 sell signals in energy stocks, ConocoPhillips and Holly Frontier, HFC, and then we see Centene turn bullish, and Mosaic, which is agricultural stocks, done very well. They're raising the estimates. So look at all that information condensed down to one email at 8 in the morning. Let's see what happened to Holly Farms. It was trading at 65.74. There's your sell signal just less than a week ago. This morning, the stock dipped under $60. Now, we had been very bullish on the oil refiners because the power gauge was bullish all through 2018. But something has changed here in the last 2 months. Obviously, the price of crude oil dropping below $60 had a lot to do with it. But Holly Frontier, which had been outperforming the market, we know that because the relative strength indicator is green, began to underperform the market. We call that a bearish personality change. And we look for a sell signal after that to put on an options position. If you're long the stock, I'd prefer that you just sell it at that point, but that's a good spot to do a covered right if you don't want to sell it, but you want to generate some income. Bottom line is, in 3 days, 2 days really, Holly Farms dropped from 66 all the way down to 60. Based on that alert, I could have taken action on it. It's actionable. Now, what is, to reiterate, a personality change? A bearish personality change comes when a stock that's been outperforming the market begins to underperform the market. Really important that you know how to spot these if and when we get into a bear market, or for the stocks that we just looked at like Mohawk and Whirlpool, where you've got a downtrend in a bull market. So here's another example of a bearish personality change. Back in the spring, everybody owned Lam Research, Micron, and AMAT. That's all they were talking about on CNBC, Fast Money. But something changed. AMAT was a great stock with a bullish rating, but back here in April, you had a bearish personality change. It went from outperforming to underperforming. Institutions were selling, the power gauge turned neutral. So what do? We wait for the first sell signal, and that's where we want to put on a put position. Now, again, if you're long the stock, my preference would be just get out. You probably have a big profit at that point. If you just bought it recently, take a small loss. The alternative is to sell options when you see that signal. But the key is the bearish personality change. Now, Wynn Resorts had a bearish personality change, and my partner Dan Russo, who's our chief market strategist, great technician, made it his bearish stock of the week up here at 158. Bearish personality change, you're waiting for the first sell signal. I made it my bearish stock of the week at 148. We covered the short sale for a 21% gain, and there was an associated vertical put spread, which we covered for more than 100% gain. Follow up on the recommendations, very methodical. The stock dropped from 160 all the way to 95. And again, all the three elements of the Chaikin classic bear are in place. Power gauge bearish, underperforming, institution selling. You wait for the signal. It's methodical. It's disciplined. You can do it. Our members have been doing it now for 6 years. Here's a stock that I'm very bearish on right now. It's Netflix. I mentioned it on Kramer's show a week and a half ago. The stock was trading at about 305. In my weekly market letter, I said, short it on any rally between 320 and 330. That's exactly what happened. We got up to 332, and today it was trading at 284 earlier. Everything is bearish. Power gauge, underperforming the market, institutional selling, the rallies are failing. These are those overbought sell signals on new 8-day highs. If you're looking to bottom fish in Netflix, don't do it. But if you're looking for a way to make money on the downside with put options or vertical put spreads, Netflix should be on your radar screen. Now, I'm going to turn the mic back to Tony, who's going to walk us through some basics that are important whether you're a new options trader or an experienced options trader. We really want you to understand very simple dynamics that are going on in the options market.
Yeah, thank you, Mark. So going back to what I was saying before about as a beginner, when you're starting out with options, the first thing you have to choose is a strategy. So you're doing your technical analysis, you're doing your research on the underlying stocks, and you come away with a view. Either you're bullish on the stock or you're bearish on the stock. So the two simplest option strategies that you can trade based on those two basic views is a call option if you're bullish on the stock, and a put option if you're bearish on the stock. A call option gives you a right to buy the stock at a fixed price. So this will benefit you as long as the stock goes higher in value after you buy the call option, and vice versa. For the put option, it gives you the right to sell the stock at a fixed price. So you will benefit as long as the stock moves lower after you've purchased the put price, the put option. So these are the two basic strategies that you can trade. And this is really where you want to start learning about options with respect to trading a directional view, because all other strategies will be in some way, shape, or form based on this first fundamental understanding of buying calls and puts to speculate on direction. The second thing that I think is very important to understand when you're trading options or when you're starting to trade options is the fact that options expire. So when you buy a call option or a put option, that option value will actually erode with time. And as it goes on, as time marches on, as you get closer and closer to expiration, that value of your option is actually going to decay faster and faster, especially in the last 30 days before expiration. So this is a really important thing to understand when you're buying an option, is that you actually want to start with an option that's usually at least a little longer than 30 days out. We usually start you off with about 45 days out, because that's where you have you don't have that accelerated loss of option premium as you get closer to expiration. So this is really one of the two of the key things that you want to understand is which strategy do you want to start off with, and understanding how timing affects the option pricing. Second, what we want to talk about is the fact that because when you're buying a call or a put, you have timing working against you. One of the best ways to help you mitigate some of that time decay is trading a vertical spread. So this is that third strategy that we'll show you, and this is a slightly more advanced strategy, but there are some additional benefits, because what we're doing here is instead of just buying a 150 call because we're bullish on a stock, what we're also going to do at the same time is we're going to sell a 160 call against that 150 call that we've purchased. And what that does is it offsets some of the cost of purchasing the 150 call, which means that we've reduced our overall risk, because what we pay for an option is the maximum risk that we have with any of these strategies. And that's one of the key things about trading options, is that you can take a directional view, whether you're bullish or bearish, But if you're wrong on that view, you actually have limited risk. Unlike a stock, if you buy a stock and you get it wrong, that stock can potentially go all the way down to zero, where you lose quite a bit of capital. With options, you're risking a substantially smaller amount of capital, and even if you're wrong, that's the most that you can risk. So with a vertical spread, what you're doing is you're basically offsetting the long leg with a short leg that reduces your risk, reduces the amount of capital it requires to help you get into that trade, which also magnifies your returns if you're correct. But thirdly, the short leg on the vertical spread will actually offset some of that time decay that you have on the long leg. So that really means that you're slightly less time sensitive in holding on to a vertical spread than you are if you're just buying a call or a put, which has some additional benefits of really allowing you to maintain exposure, a bullish or bearish exposure, for a little longer than you would be able to if you're just buying a call or a put.
And at the end of the webinar, we're going to show you two of my favorite vertical call spreads, very popular stocks, high priced, where you'd have to put a lot of money into buying 100 shares or 200 shares, that I think are prime candidates for a year-end rally. And the vertical call spreads are the way we're going to show you to play them with limited risk and limited capital exposure. So, Tony, here's really what today's webinar was billed to be all about: writing covered calls to enhance returns. So if you could briefly walk people through this slide, we're then going to get to some very specific covered calls that people can be putting on right now.
Yeah, so covered calls is the first option strategy that you're actually approved for when you apply for an options account. And this is a strategy that allows you to generate income off of the stocks that you already own in your account. So think of the stocks in your account as assets that you can sell some covered calls against to generate some yield. And this is really one of the first places to learn about option selling. The first two examples that I gave before, buying a call or a put, those are option buying strategies. A covered call is the first option strategy that you might encounter as an option seller. And as an option seller, what it allows you to do is actually collect some income, very similar to selling or collecting dividends on a stock. However, some stocks may only pay 1 to 2% dividend. Some of them pay 0 dividends. So covered calls is a way that you can monetize the assets that you already have in your account by selling a call option against the stock that you own, which gives you the obligation of selling the stock at that strike price in the future. However, that brings you some income. Now, in this current market environment where we've had a pretty big sell-off in the markets, volatility is at elevated levels, which means that you are going to collect more premium or higher amounts of income for some of the covered call opportunities that we're going to show you here today. Because as an option seller, you're going to be able to take advantage of that high volatility and be able to add some additional yield to your portfolio using the stocks that you already have in your account, and you don't have to add any additional risk to your portfolio in order to sell a covered call.
So let's look at a template, a strategy for how to sell covered call options to generate consistent income using quality dividend-paying stocks. It's a really three-step process. You find stocks with a bullish power gauge rating, solid and growing dividends, I like 2% or more, and then generous premium for selling short-term out-of-the-money call options. It's a strategy that works over time, not all the time, so you can't look at the value of your account every day or every week. It's a long-term strategy. If you put together 10 stocks like this and you're pocketing the dividends every 3 months and you're writing out of the money calls, you can generate really nice returns. So let's look at a good example here. General Mills, it's in the food group. Defensive stocks are doing well because the market is nervous. Consumer staples, very strong sector. Power gauge had been bearish on General Mills, but it's been in a basing phase for a good 8 months, and now the power gauge has turned bullish. So for me, this is a prime candidate for a buy and write. You could buy the stock, which was trading at 45, 48 this morning, and immediately sell a covered call with a strike price 3 points above where you bought it, 47.50, that expires on January 18th. So it's roughly a 2-month options. The stock pays a 4.2% dividend yield, and the next dividend is January 8th. So we're suggesting that you buy the stock and write a call that expires after the dividend. So you're going to pocket the dividend, and that's going to be about 1.05% for the quarterly. And you get a 2.5% return by getting $113 for the covered call. So you're buying the stock at 45.48. You know you're going to pocket 105 in the dividend, and you've got a really nice 2-month return of 2.5% on the covered call. If the call expires worthless because the stock is less than 47.50 in January, you pocket the dividend and the options premium, and then rinse and repeat. You do it again, looking to sell another out-of-the-money call. This is your basic buy-right strategy. You find stable stocks with a bullish rating, pay a nice dividend yield, and in this case, as Tony said, option premiums are pretty high because volatility is up. Now, I took General Mills because this looked like such an attractive strategy, and I seeded our stock discovery engine with the symbol GIS for General Mills, and it immediately came back to me with other stocks like General Mills. And what are the characteristics? Food group, large cap, strong earnings consistency, buy signal, high dividend yield. So Smucker's, Mondelez, and then also high dividend paying stocks that are similar to General Mills. There are Smucker's again, and Molson Coors, and some electric utilities. This is a very powerful way to find potential options buy-right ideas using our stock discovery engine. So I went to Molson Coors and I saw something I like. The power gauge has been bullish off and on for a year. The stock is sort of breaking out of a base, starting to perform better. So you could buy the stock at 64.49 this morning. And Tony, why don't you walk us through the covered call right that you could have put on this morning?
So this stock is trading just below $65. This is looking at selling a 67.5 cover call, which is about $3 above the current price in 45 days. And as you can see, you're going to collect 1.47% of the underlying cost just for selling this cover call on a stock that pays a 2.5% dividend. So this cover call returns about a 12% annualized return. So if you own this stock, or if you plan on buying the stock, you're looking at a dividend of about 2.5%. This is adding an additional 12% on top of that if you're able to do this, rinse and repeat this throughout the year. But you are going to be able to pick up this stock at 1.5% discount by selling this cover call, and you're going to be able to potentially take on the upside exposure if the stock does take off to the upside. And this is really, these are the types of yields that we're not seeing very often, especially in stocks like this, getting 1.5% on a 45-day out-of-the-money call option.
And of course, OptionsPlay right up here shows you when the next dividend is. It's November 28th. So if you bought the stock today or you buy it tomorrow, and again, these are educational. They're not specific recommendations, but these are trades that you can evaluate and put on now. You're going to capture that dividend. You're going to get that dividend on November 28th. That's really important. And then hopefully the options premium adds to that. And if the stock's higher than 67.5 on December 28th, it could get called away from you. That's fine. You've made 3 points. You've made the dividend. You've made the options premium. That's what this is all about. Find 10 stocks like this. If that's the program you want to put into place to generate income, you can actually reinvest that income in the stock if it goes down. If you don't need all of that income to live, think about it. You're generating cash. You can put it to work and average down on the stock if it goes down. So it's a reinvestment program as well as a covered call right. Now let's look at Smucker's. That was the other stock that showed up on the stock discovery engine. Again, a stock where the power gauge has been bullish off and on for a year, trading at around 113. Again, you can sell the covered call above the market. So in this case, we're looking at the 120 call. So there's about 6.5 points of upside potential. You're taking in $310 in premium income for an option that expires on January 18th, and you've got a dividend yield of almost 3%. This is how you can generate consistent income with a covered call program in dividend-paying stocks with quality. These are quality stocks. They're not the exciting high-tech names that we play for the big upside. And in plain English, OptionsPlay tells you right down here what's going on. So it's not a mystery. It tells you what the annualized return is, and you're well informed, and stick to the plan. Find 8 to 10 of these, create a portfolio, and you've got an income machine generating profits. And again, you can take that money that you don't need to live on and reinvest it in the stocks. Now, one of our members, Jim Davidson, did just that. He gave us this testimonial over 2 years ago: a better night's sleep and impressive returns. After getting hammered in the August 15 correction, I decided to take advantage of what Chaikin Analytics really offers. That is a better night's sleep and some impressive returns. Rather than swinging for the fences and striking out, Jim said, I've learned to do what the system tells me to and enjoy my 16% return. Thanks to the Chaikin team for giving my confidence and a good night's sleep back again. That's what you can do. Jim's in Atlanta. We see that Atlanta Braves hat. And very happy to be generating consistent income. Now, there's another way to find candidates. We use that discovery engine, but we can go back to our screening program, which is what I did this morning. I started with the S&P 500 because I'm looking for large cap bulls with high dividends. Just required that the power gauge be bullish and that the dividend yield was at least 2%. And surprisingly, only 35 stocks qualified. And the names we just looked at are on there: Smucker, Coors, General Mills. And then I saw some other names that look really interesting, like Verizon and Simon Property Groups. And the reason they looked interesting to me was that I knew we had generated recommendations and buy signals on these stocks. So this is another way to approach call writing. Let's say you bought Verizon based on our relative strength buy signal back here in September. The stock was trading around 54, and you now see it up near the upper volatility band around 59. So you bought the stock for appreciation, and you want to hold on to it, but there's an opportunity here. As Tony said, volatility's up, options premiums are up. So this morning, you could have sold a covered call option on a stock that you already had a profitable position in. In this case, the 60 call option, which is above the market, that expires on December 28th, you take in almost $1 of premium. That's 1.64% on top of the 4% yield. You got that dividend in October for an out-of-the-money call option. You're increasing your returns. In this case, you bought the stock to make money on the stock, but now with the stock at the upper volatility band, you can take advantage of the call option premium to increase your returns. Same thing with Simon Property Group. I made this my bullish stock of the week back here in July. It's one of the only REITs that's made a new high here in the last 6 months. It's the premier mall operator. They're taking advantage of the trouble that Sears and Kmart are going through. They're really experienced. They're premium properties. So we recommended it as my bullish stock of the week in Chaikin Market Insights. The stock was around 170, and it's been a choppy road, but guess what? As of yesterday, it was making a new all-time high at 190. So look at the premium that you can get. Tony, you talked about high premiums. Why don't you talk about this $5 premium on a covered call in Simon Property?
Yeah, so holding the stock, you get a really nice 4.25% dividend, but you can collect more than half of that just in the next 65 days by selling a cover call. So this is really where you can add some real yield to your portfolios, especially if you own these types of stocks, by selling these out of the money cover calls. So this is a 188 stock. We're selling a fairly close to the money call option, but I'm guessing you're doing that because you're near that upper volatility band. And we feel that at the very least, you might get a short-term pullback where that's not going to go much higher from here in the short term. And that's what allows you to get a little bit more aggressive. So Chaikin Analytics helps you time your cover calls as it hits these upper volatility bands, get a little bit more aggressive, and really chase these high yield plays that get you 2.73% return in just 2 months, which annualizes out to 15% compared to just the 4.25% you're getting from the dividend yield. So this is really a great way to add additional yield to the stocks that you already own in your portfolio that are only collecting, what is the average S&P dividend yield is a little over 2%. A lot of these cover call positions that we're looking at now are yielding 10, 12, even 15% over the year. And that's really why we want to take advantage of this elevated volatility and generate some additional yield.
And of course, premium erosion that you talked about earlier is working in your favor. So you mentioned aggressive. Let's look at some aggressive strategies now. There are your covered call and buy right strategies. Now let's look at how to take advantage of volatility and fear using the power gauge rating and the options play ideas and the rule-based entries. So here's a really advanced strategy that Tony and I have shared with people before. And Tony, the microphone is all yours because I know this is one of your favorite strategies.
Yeah, so cash secured puts is one of the option trading strategies that I think is probably most underutilized by a lot of option sellers. Because a cash secured put, a lot of people find, or I hear people say that cash secured puts involve a lot of risk. But I think you have to consider what you're comparing it to. If you're comparing it to buying a put, sure, there's a lot more at risk. However, the correct strategy to compare a cash secured put to is simply outright buying the stock at the current price. Because a cash secured put is really an alternative to outright buying the current stock at the current price. So if you think about it from that perspective, it's actually less risk for you to sell a cash secured put than buying the stock at the current price. And what it does is it allows you to collect some premium and at the same time potentially pick up the shares that you want at a lower price. And that's really the goal of a cash secured put, is to allow you to effectively dollar cost average into the stocks that you want at a lower price while collecting some income or some premium to put in that order to buy that stock at a lower price. And this is something that I think people should be thinking about whenever you have a stock that you're interested in buying. Maybe you think the current price is a little high, so what do you typically do? You put a limit order to buy it at a lower price. This is very similar to that. By selling a downside put, you have the right to buy the stock at the price that you sell the put at, but you're going to collect some premium in order to do so, and that's going to offset the price of the stock and collect some income for you. So this is a CRM, and I think Mark will walk you through that, and I'll walk you through the short put.
So here's one of my favorite cloud computing software plays, Salesforce.com. Had a bullish power gauge rating, made a new all-time high at 160 in September. Given the debacle in the tech sector with Netflix and Apple and Amazon getting really hammered, Salesforce has held up really well. So it was 132 this morning, and I expect a year-end rally that's going to take us to new highs. But I'm not even assuming in this particular position that we're going to get up to 160. I'm looking at our long-term trend line, double smooth 200-day average, which is at around 150. So stock's 132. I think it could rally to 150, maybe beyond by year end. So using OptionsPlay, I zeroed in on a strategy where you could sell an out-of-the-money put. This is a put with a strike price of 120. So it gives someone the right to sell you, Salesforce, which is now 132, the stock at 120. And Tony, what are the returns on a strategy like this? Tony's mic might have gone out. I can tell you that this is a 25% annualized return. So if you're sitting on cash, let's say you have that $13,000 to buy Salesforce, you don't want to put it to work. You sell the put option, you bring in $215, so 1.63% return. But look where this option expires 2 weeks from now. people are so nervous, option premiums are so high that you can generate a 1.63% return in just 2 weeks. That annualizes out at 26% a year. Excuse me, I've got to drink some water.
Yeah, so sorry, I was on mute before. So 1.63%, imagine getting a 1.63% discount on all the stocks that you purchase just by putting in an order at a limit order for 120. So this allows you to buy the stock at 120 if the stock goes below 120 by December 7th, which is a big move. It's a $12 move to the downside in 3 weeks. And as long as that doesn't happen, you get to keep this 1.63% and rinse and repeat and do that over and over again. And then at some point, maybe you do that 2, 3, 4, 5 times, and eventually the stock does move lower. And that's when you're able to pick up the stock at a lower price. But at that point, you may have collected 5, 6, even 7% of the underlying cost. So you're dollar cost averaging and getting a discount every single time you're doing these cash secured puts.
For a sophisticated strategy for people who are sitting on cash and understand the risks. If you do it on margin without having the cash to support it, that's much too aggressive, because if you get into a bear market, people have gotten wiped out with this. But used intelligently in strong stocks that are likely to rally if the market rallies, it's a great strategy. We're also going to show you a second strategy on Salesforce, which assumes an upside move as well, but a different vertical put strategy, and that's coming up right now. Vertical call spreads on stocks that led the market to new highs in September. We're just going to zero in on 2 high-priced stocks, Amazon and Salesforce, to end the webinar. Here's Amazon. It peaked at 2,000 back in September. Everybody was bullish. The power gauge was bullish, but money was coming out of the stock. There's your bearish money flow sell alert, by the way. Overbought with negative money flow. But let's assume that you believe in the year-end rally concept. Where is the resistance? It's at 1900. That's where our long-term trend line is. When it was broken, it was the start of a big waterfall for Amazon. So you could buy 100 shares of Amazon right now, this morning at any event, cost you $161,945. I don't know anybody who's got that kind of cash sitting around to buy 100 shares of stock. And you have unlimited risk. The alternative is the vertical call spread that we talked about in the options educational portion. Stocks 1619, you can buy the 1620 call that expires on December 28th. And sell that 1850 call against it. Reduces the cost from 9,300 to 7,300. You're buying upside participation at a discount. And if the stock does rally back up to 1850, you make over a 200% return on your money. So would you rather spend $7,385 or $161,000? With unlimited risk? Here you know what your risk is, and you know what your return is going to be. You get to 1850 by December 28th, 211% return. Along the way, you got to manage your trade in case things go against you. Now, we've previously looked at Salesforce, and you can do the same vertical call spread in Salesforce, 132. Instead of spending $13,200 to buy the stock, for $614, you can put on the vertical call spread, meaning you buy the 132 call and you sell the 150 call against it. You reduce your cost from $795 to $614. If the stock goes up to 150, and that's exactly where the resistance level is right now, by December 28th, it's almost a 200% return. The probabilities are in your favor. It's a way to play a year-end rally with a limited amount of money. Don't commit all your capital to that strategy. But instead of risking 13,000, you risk 600. This is probability working for you and premium erosion working for you instead of against you. So I think we've shown you how Chaikin Analytics can improve your options trading by giving you that directional edge, the power gauge rating plus the buy-sell signals, and OptionsPlay really give you the edge that you're looking for. So Chaikin Analytics is the platform. It's a proven stock selection system with options play ideas and daily email alerts. Really critical. Pushing actionable ideas to you every morning at 8 o'clock. Normally sells for an annual subscription of $2,195. You can go to chaikinanalytics.com/calls. But as a webinar special, we'd like to take $300 off the cost of Chaikin Analytics, reducing it to $1,895 a year. If you're trading options or generating income, you should be able to make back the cost of the subscription membership very quickly. chaikinanalytics.com/calls. Offer expires on November 17th, which is Sunday. Now, you've seen the screener, you've seen the options play ideas. There's a lot more in Chaikin Analytics, but we wanted to stay focused on this webinar. But I will tell you that as a Chaikin subscriber, you get member-only access to our weekly strategy webinar with our market strategist, Dan Russo, and Josh Minlin, who's on the webinar today. Got a special offer for you in a minute. Unlimited coaching with small group support sessions and one-on-one coaching if you need it. And Dan Russo's Daily Morning Insights. That's where he recommended Win as his short of the day. Mohawk as well. So a lot comes bundled with Chaikin Analytics. You get my weekly market insights as well. Comes out on Sunday. But I'd like to offer you a fast action bonus. If you join Chaikin Analytics, subscribe by midnight tonight, you'll receive the next 4 weeks of our newest product, Options Ideas, from our in-house strategist, Josh Minlin. You'll receive your first options idea on November 21st via email. Subscribe tonight. We'll take an additional $100 off, reducing the cost to $17.95, and you'll get complimentary 4 weeks of our options trade of the day. chaikinanalytics.com/calls. We have people standing by if you want to ask any questions, 877-697-6783 or sales@chaikinanalytics.com. But I hope we've demonstrated to you that a methodical approach to options trading, in this case, primarily income-oriented strategies, but we ended with some more aggressive strategies, can pay off for you. And you can be that 5% of people who make money in options instead of lose money. So with that, I'd like to thank our partner and friend, Tony Zhang. Tony, do you have any final words for the people?
I just want to thank everyone for taking the time out this afternoon. I really hope that we were able to show you the power of having a directional edge with Chaikin Analytics and how you can leverage that quickly into option strategies with OptionsPlay. It's a tool that I haven't been able to live without since we've started our partnership. I use your platform every single day to look for stocks, opportunities, and then use OptionsPlay to leverage them into the vertical spreads that I trade in cover call opportunities. And I really hope that you guys can see the same value as well.
Well, thank you, Tony. And now we're going to turn it back to Josh Minlin. And Josh, I'm really proud that you've launched this new service, our weekly options ideas. And why don't you wrap up the webinar?
Thank you, Mark. I'm very excited for it. I'm very excited to have people join us. So please give us a call at 877-697-6783. My colleagues can answer any questions you have and can help you get signed up and ready to go. We can have you on an onboard session this week. We can get you into my option idea sessions that we hold on a weekly basis right away, as well as Dan Russo's call that he does with me on Mondays, our open forum. It's incredible value. Again, you can subscribe by going to www.chaikinanalytics.com/calls. Again, that's www.chaikinanalytics.com/calls. I put it into the chat window for you, or you can call us at 877-697-6783. Thank you, everybody.